Why hasn't the economy collapsed? Short answer, a mix of policy, institutions, and adaptation has kept systems afloat despite shocks. In the next 5 minutes, we'll map the main stabilizers, show the data that matters, and explain the risks that could still tip the balance. Quick preview: central banks, fiscal backstops, banking rules, global trade and productivity, plus consumer and corporate resilience. Those 5 keep the system functioning. First, a quick data snapshot. GDP growth, unemployment, inflation, and credit spreads tell the immediate story. Watch the chart as each metric updates. Numbers matter, but interpretation matters more. A slow growth reading doesn't equal collapse when liquidity, policy, and confidence hold. Context is everything. Let's dive into each stabilizer, starting with central banks and why their actions have been so decisive since major shocks. Central banks acted quickly to provide liquidity. Lower rates and emergency lending kept credit flowing and prevented fire sales and risky assets. Large-scale asset purchases, often called QE, pushed yields down across the economy, easing borrowing costs for households and firms. Central banks also use targeted facilities to support specific markets like corporate credit and short-term funding. That backstop lowered panic risk. Forward guidance and clear communication mattered. When policymakers signaled persistence, markets priced lower odds of extreme tail events. These actions didn't erase risks, but they bought time and restored functional markets, a precondition for avoiding systemic collapse. Next, fiscal policy filled gaps that monetary tools couldn't, directly supporting incomes and preventing sharp demand collapses. Governments deployed fiscal packages to stabilize incomes and business cash flow. Direct transfers and wage supports limited consumer collapses. Small business loans and loan guarantees prevented mass bankruptcies, preserving productive capacity and jobs in many sectors. Fiscal action varied across countries, but common themes were speed, scale, and targeting to the most vulnerable sectors and households. Automatic stabilizers, unemployment insurance, and progressive taxes also dampened downturns without new legislation in many places. Fiscal capacity isn't unlimited, but timely programs preserve demand long enough for markets and policy to recalibrate. With policy support in place, the financial plumbing could function. That brings us to the third reason: banking resilience. Banks entered crises with stronger capital and liquidity buffers after post-crisis reforms, reducing the chance of contagious failures. Stress tests and contingency planning meant supervisors could act decisively, and markets expected backstops when needed. Deposit insurance and emergency lending lines cut incentives for bank runs, maintaining public confidence in the payment system. Non-bank finance and shadow banking remain risks, but central bank facilities often extended to short-term markets to calm funding stress. Operational resilience, payments, clearing, and custody was maintained through redundancy and technology investments, preventing systemic stoppages. Those banking defenses bought policymakers space to treat the real economy rather than fight a financial panic alone. Reason 4, diversified trade and supply chains. Global trade adjusted, inventories rebuilt, and alternative suppliers emerged to prevent total breakdowns. Reason 5, productivity gains and technology. Remote work, automation, and logistics improvements helped output recover faster in many sectors. But risks remain. High public and private debt, inflation volatility, geopolitical shocks, and abrupt confidence losses could still trigger crises. Policymakers can't guarantee outcomes, but the combination of tools and structural strengths has repeatedly prevented a full-blown collapse so far. 5 key takeaways: liquidity, fiscal support, resilient banks, diversified trade, and tech-driven productivity. Together, they form the defense. Summary: collapse was avoided not by luck, but by coordinated policy, structural resilience, and adaptation. Stay informed, watch risks, and prepare. Visit our site to learn more.